It's funny how some things just they always grab our attention, right?
Hmm.
No matter what else is going on.
Hmm.
And gold's definitely like that. I mean, for centuries, it's been this universal symbol of value. Yeah. A safe harbor when things get rocky economically.
Definitely. But it can still feel a bit mysterious to a lot of people.
Exactly. That's the thing. It has this amazing history, this mystique, but the day-to-day price moves, they can feel a bit, well, bewildering, almost like they're following some secret code.
It can seem that way from the outside,
Hmm.
absolutely. But underneath, gold's price is uh, always responding to really specific things. Interconnected forces, often. There's a logic there, even if it seems complex at first glance.
And that's exactly what we're doing today. This is our deep dive into gold's recent market action. We're really tackling that big question. Is gold going to keep falling on July 29th?
We've got this pretty comprehensive market analysis and trading strategy document right here.
Yeah, and our mission is basically to pull out the key insights from it.
Oh.
Figure out what levers are being pulled, what the sort of invisible battles are that drive gold's price. We want to give you, our listener, a much clearer picture of what's really going on.
And this analysis is particularly good because it's based on a really detailed market review. It's not just surface level stuff.
Right.
It digs into the fundamentals,
Yeah.
the big global economic stories, but also those really intricate technical signals, the ones that show what investors are actually doing. It's a holistic view.
Okay, so let's start there. The big picture. What are these sort of powerful global economic currents pushing and pulling gold right now? The analysis mentions a couple of short-term things, giving it some support, at least temporarily. What's going on there?
Well, what's really interesting is how the market reacts to just waiting. Right now, we're seeing the US dollar weaken a bit, mostly because everyone's holding their breath, basically,
Mm-hmm.
waiting for the Federal Reserve's big interest rate meeting.
Ah, the Fed meeting.
So US dollar strength is kind of paused.
Mm.
And that pause, that little bit of softness in the dollar, actually helps assets like gold that don't pay interest.
How so?
Well, gold is priced in dollars globally, so if the dollar gets a bit cheaper, gold automatically becomes more attractive for buyers using other currencies. It's a direct link.
Okay, so it's like a temporary boost for gold while the market waits. And then there's the classic one, safe haven demand. You mentioned the Fed decision, that's big policy uncertainty. How does that push people towards gold?
Yeah, that flight to safety is just, it's always there with gold, isn't it? When investors are facing big question marks, especially from somewhere like the Fed or, any major geopolitical stuff,
Hmm.
money tends to flow into gold, at least for a while. It's seen as that solid, reliable thing, a place to wait things out when the road ahead looks foggy. It's just a rational response. I don't know what's coming. Let me put some cash in gold just in case.
Makes perfect sense. Uncertainty pushes you towards perceived stability. But you mentioned earlier there are also headwinds, things pushing against gold. What are those factors? How strong are they?
Yeah, those supportive factors are definitely fighting against some pretty strong headwinds right now.
Yeah.
The main one, easing trade tensions globally.
Ah, right. We've seen some movement there.
Exactly. We've seen real progress like the US-EU tariff deal and things moving forward with US-Japan, US-China talks too, when those big uncertainties start to fade.
People feel better about the economy.
Precisely. Overall, market risk appetite goes up. Investors feel more confident. Maybe they move into stocks or corporate bonds, riskier assets generally. And that makes gold, the traditional safe haven, seem, well, less necessary. You don't need an umbrella if the clouds are clearing, right?
That's a great analogy. So if you're optimistic about growth, you look for higher returns elsewhere, not safety in gold. It really does sound like gold's price is stuck in a tug of war right now. The analysis calls it a bull-bear game, balancing these big macro games with technical adjustments.
That's a really crucial point. The market's basically treading water. It's waiting, very much waiting, for clarity from the FOMC statement. That's where the Fed gives its rate decision and its outlook.
Okay.
And beyond that, you've got key economic data coming up too.
Yeah.
GDP, gross domestic product, overall economic health, and PCE, personal consumption expenditures, which is the Fed's preferred inflation measure.
Big numbers.
Huge. Until those pieces fall into place, gold's direction is likely to stay pretty choppy, just caught between these strong opposing forces.
Okay, so that leads us naturally to the technicals. What are the charts the market's own diary essentially telling us? Because this is where we see specific signals about what the market itself thinks. Let's zoom in. The analysis highlights something it calls the most important signal from April to June, a long upper shadow on the monthly and weekly charts. What on earth is a long upper shadow, and why is seeing it 3 months in a row such a big deal?
Okay, so a long upper shadow. Think of a candlestick chart. Each candle shows a price action for a period, like a month or a week.
Right, the body shows open and closed.
Exactly. And the shadow, or wick, shows the highs and lows. A long upper shadow means that during that month or week, buyers managed to push the price way up, hit a high point. But, and this is key, by the end of that period, sellers came in strong. really strong, and they push the price all the way back down, often near where it started, or even lower.
So it's like the market tried to rally but got slapped back down hard.
That's exactly it. It's a visual representation of strong rejection of higher prices. The market tested higher levels and failed decisively.
Wow. And seeing that for 3 straight months, April, May,
But
June.
that's a very powerful, sustained signal.
Mm.
It's telling us repeatedly that whenever gold tries to make a significant move up, there's heavy selling pressure waiting to crush it. And the analysis warns, if July closes with another one of these long upper shadows,
Oh.
it could strongly confirm that the bears, the sellers, are really in control. And if that happens, the analysis suggests the market could fall further, potentially testing that 3,000 down to 2,950 region. It's the market shouting, we're not ready to sustain higher prices.
That is a pretty clear warning signal, like a recurring pattern of failure at higher levels. And speaking of levels, the analysis also flags the 3,400 to 3,500 area as historically strong resistance, a ceiling, basically.
Yes, that zone has repeatedly capped rallies in the past.
And it even warns that if the Fed cuts rates, which you'd normally think is good for gold, a rally up to that 3,400, 3,500 level could actually be a buy trap before a reversal.
What's a buy trap mean here?
A buy trap is, well, it's a serious warning for traders. It suggests that a move that looks positive on the surface, maybe sparked by that Fed rate cut, could suck buyers in. They jump on board thinking it's the start of a big rally.
But when the price hits that specific 3,400, 3,500 resistance zone, the analysis expects massive selling pressure to emerge, just overwhelming those new buyers and forcing the price sharply back down. So those buyers get trapped in losing positions bought near the top.
Ouch.
Yeah. It highlights just how strong that resistance is perceived to be. Even potentially positive news might not be enough to break through it cleanly. It suggests the, let's say, smart money isn't convinced about a sustained rally yet.
Okay, so those long-term signals are definitely flashing caution signs. What about the very short term, the immediate path? The analysis picks out 3350 as a critical bull-bear turning point on the daily and 4-hour charts. What's special about 3350?
This is getting down to the nitty-gritty for day-to-day trading. 3350 is basically the immediate line in the sand. If gold can get above 3350 and crucially stay above it, that could signal enough bullish momentum right now to push higher, maybe towards 3370 or even up near 3405 resistance. But if it stays below 3350, the expectation is for it to drift lower, maybe towards 3330 or even down to 3290. It's a very clear immediate pivot point.
Got it. And it seems gold's recent behavior has been tricky. The analysis mentions weak long-short continuity, like sharp rises followed by sharp falls, like last week. And it warns about repetitive fluctuations. How does that complicate things for traders?
That weak continuity means trends just aren't sticking around for long. You get a move up, looks promising, then bang, it reverses. You get a move down, looks like a breakdown, then pop, it bounces back.
Sounds frustrating.
It is. It's very choppy, very volatile. For traders, it means you have to be incredibly careful about chasing moves. Buying into strength or selling into weakness can backfire really quickly. It just suggests there's no strong, sustained conviction in either direction in the short term, despite that bigger picture bearish lean we talked about. It's a market that really rewards patience and agility and punishes getting locked into one view too soon.
All right, so putting this all together, the big macro picture, the technical warnings, this inherent choppiness, how are traders actually trying to play this? What's the overall strategy coming out of this analysis?
Well, the main takeaway, after weighing everything, is that gold seems to be in what the analysis calls a volatile downward trend. So there's volatility, but the underlying bias is down.
Okay.
Given that the primary trading idea suggests it is to short on recovery peaks. And this is vital always with a strict stop loss.
So wait for it to bounce up a bit, then sell.
Exactly. You're not trying to guess the absolute bottom to buy. Instead, you let the price recover a little, hit a temporary peak, and then you place your bet that the main downward trend will resume. It's a tactical approach, selling into temporary strength within that broader downtrend. Requires discipline.
Right. Selling rallies, not buying dips, essentially. And the analysis gets really specific with levels for making those decisions. What are the key resistance levels they're watching for those shorting opportunities?
Yeah, the key numbers. For potential short entries, the primary zone they're watching is 3330 up to 3335. That's the first line of defense for sellers.
Okay.
If gold pushes through that, the next secondary resistance area is seen around 3345 to 3355. Now, on the other side, the support levels where buyers might step in temporarily, the primary one is 3300 to 3305.
And if that breaks?
If that gives way, then the next potential target lower is identified down around 3280 to 3270. These levels are literally the battle lines traders are focused on.
And it even lays out some scenarios. What about aggressive traders? Those willing to take on more risk? What short opportunities does it highlight for them?
For the more aggressive folks, they might look to initiate shorts within that first resistance zone, the 333, 33340 range. They'd be aiming for a rejection there. However, if the price climbs more convincingly, say above 3335, the advice is maybe to wait. Wait for a stronger push up into that second zone, 3345, 3355, before trying to short. But in both cases, the absolute key is a tight stop loss. Maybe just above 3350 for the first scenario, or maybe above 3260 for the second. It's about defined risk, tactical hits.
Okay, definitely focused on the short side. Is there any consideration for going long, buying gold, even cautiously?
It does touch on it, but very briefly and very cautiously. It mentions the idea of trying a light long position if gold finds clear stability around that 3305, 3310 support area.
Light being the operative word.
Very much so. It's framed as a short-term recovery play only. The advice would be a very tight stop loss, maybe just below 3300, and really limited profit targets, perhaps just looking for a bounce back to 3310 or 3320. It's definitely not about catching a major reversal, just a quick potential bounce. The overall tone is overwhelmingly favoring shorts.
It really sounds like it. And the analysis also stresses being careful about chasing breakouts,
Right.
confirming trends first or waiting for a pullback. Why is that so crucial in this kind of market,
Well, going back to that weak long-short continuity, the choppiness.
right?
Chasing breakouts is super risky. A price might poke through a key level, looks exciting, traders jump in,
Right.
and then wham, it reverses right back, trapping them. Happens all the time in markets like this.
Fake outs.
Exactly, fake outs. So the analysis suggests it's much better to wait, either wait for real confirmation that a new trend is actually holding, or perhaps even better, wait for a pullback after the breakout to get a potentially safer entry point. Don't just react to the first spike. It's a reminder that patience often pays off, especially when things are this volatile.
Okay, so let's bring it all home. What does this deep dive tell us about gold's potential moves on July 29th, especially with those massive risk events, the Fed, the data looming?
Yeah, the Fed decision it's huge,
Yeah.
paramount. The analysis specifically warns, even if we get a rate cut, if the Fed's commentary, their outlook, sounds hawkish, maybe they signal fewer cuts ahead, or they're still really worried about inflation, then gold could do this rise and fall thing. It might pop higher initially on the rate cut news itself, but then quickly sell off as the market digests the less friendly forward guidance. It's a really nuanced reaction we need to watch for, not just the headline decision.
And the economic data, GDP, PCE, they could throw a wrench in the works too, right?
Absolutely. If those numbers, GDP or PCE inflation, come in stronger than forecast, suggesting the economy is holding up better than expected, that could really boost the US dollar.
And a stronger dollar is usually bad for gold.
Typically, yes.
Yeah.
That acts as a major headwind. So, strong data could potentially push gold down, regardless of other factors maybe pointing higher. It really is like a high-stakes poker game. Everyone's waiting for the Fed and the economic data to reveal their cards.
Sounds like a time for nerves of steel, whether you're trading or just watching. The analysis even mentions conservative traders might just sit this one out.
Precisely. And honestly, in an environment this uncertain, this volatile, with major news about to hit, sometimes the smartest move is to wait. Conservative traders might absolutely choose to stay on the sidelines until the dust settles after the Fed and the data releases. See which way the wind is truly blowing after the storm passes. Patience can be a strategy in itself.
So, wrapping up this deep dive on gold, especially looking at July 29th, it's just crystal clear, isn't it? The price is this incredibly complex result of push and pull.
Yeah.
You've got the big macro forces, the dollar, trade news jostling constantly, and then you have these really specific, sometimes quite stark signals coming directly from the technical charts, showing where the market itself is putting up resistance or finding support.
And understanding all those layers, how they interact, it really gives you, our listener, a much richer insight than just watching the price tick up and down.
Right.
It lets you connect those big global headlines to what's actually happening in the market. It
Right.
gives you a much more connected perspective.
Definitely. And as we finish up, here's something to maybe mull over. Gold has this unique double life, right? It's that ancient safe haven people run to in trouble, but it's also a commodity that's super sensitive to economic policy, interest rates, all that stuff.
A fascinating duality.
It really is. So the provocative thought is this. Given that dual role, what broader implications could gold's current volatility, this real uncertainty about its direction, have for global financial stability? Especially now, as central banks everywhere are trying to figure out their own paths in this constantly shifting economic landscape. It's a question that goes way beyond just the price of gold itself.
That's a really good question to ponder. Food for thought.
Indeed. We'll leave you with that. Thanks for joining us for the deep dive.